So this video is about understanding, returns of the gold versus the returns of the gold mining companies. Because recently, one of a very reputed fund manager has said, if somebody is okay with the volatility, probably investing in the gold mining companies, there are certain ETFs which are there. If you invest there, probably you'll have some extra return, right? So what I have done is like analysis of how this gold and gold mining companies ETF in dollar terms have done over a longer durations. So that is from 2012. So the reason why I have done it in the dollar terms is like when you look at the returns of the gold, so if the dollar is appreciating by 3% against the rupee, the returns of the gold will increase by 3%. On the contrary, if it is a rupee appreciating against the dollar by 3%, the returns of the gold will reduce by 3%. And why this is important? The reason is like if you look at all the Trump statements and everything, he wants to take manufacturing to USA. And for that to happen, the currencies around the world have to appreciate against the dollar. We do not know for sure if this is going to happen or not. So it makes more sense whenever you are looking when you are calculating the returns of the gold to look at more from the dollar returns perspective. The reason being it is dependent more on the dollar returns as well. And the other thing is our country has a very less amount of gold reserves, and lot of whatever is being bought in the market is something which is being imported, right? So as I mentioned, this data is from 2012, right? Overall, if you look at it, the median returns in the dollar terms are around 4% on a longer horizons. So on a 5-year return, it is 7.3%. 7 years, it is 6. Our 10-year return is around 4 percentage points. Similarly, I have calculated for gold miners ETF, right? So the same horizon. So the median returns is for 5 years, it's around 5.8%. For 7 years, it is 5.6. On a 10-year basis, it is 1.3%. When we compare this with the gold, 7 years is where there is some amount of coincidence in this time period. So on a 5-year basis, the median returns of gold is around 1.6 percentage points higher. On a 10-year basis, the returns of the gold is around 2.5 percentage higher compared to the gold mining companies. This is the ETF which we have looked at it. I have deliberately, you know, camouflaged it because you have to do your own due diligence and you have to go for it. You have to either talk to your distributor or to a financial advisor and see if this even buying this suits your asset allocation or not, and whether it is in accordance with the your goal planning or a financial plan or not, right? So now let's look at how the movement of the gold was against the gold miners ETF. So I have split across two periods from 2012 to 2018 and from 2019 to present date and from 2012 to present date. So from 2012 to 2018, the gold returns in the dollar terms have not been great. So if you look at the NAV, right? So pretty much it is like 25% of a negative return. So people are talking about this is across a 7 years of time horizon, 2012 to 2018, both years included, actually. So in the 7-year time horizon, there has been a negative return of 25%. Because the dollar has depreciated around 4%, probably will have a positive return in the rupee terms. And when we look at the gold mining companies, right? So the return has been, if you look at the endpoint to endpoint, the returns have been even more worse. So a 60% drawdown is there, right? But if you look at this graph, there is a huge amount of volatility, unlike gold. See, if somebody has invested in 2016, right? Both in gold and in the gold mining company. If you have invested in the gold, so your return would have been in the next 2 years approximately around 15% from 65 to 75. It is absolute return of, 10%, 10 points increase from 65. So that is approximately 13-14% kind of return probably. So if you look at this one, so if you have invested in 2016 in the gold mining company, right? So this would have been around like a 60% return. So from 25, 26 to 40, right? The reason is like these companies are involved in digging, even if the price is maintained for some time. So there is a huge amount of undervaluation and overvaluation that happens within these companies. So if this is flat for a while, actually the profits of this, I mean, like because of the inventory buildup and everything, so these companies will fall a lot more higher. And whenever there is a slight increase, these companies will grow higher. Let's look at what has happened from 2019 to today, right? So whenever the gold price is increasing, it has increased. Only during the 2020 COVID time, the companies have lost. But if you look at the kind of bounce back which has happened after that, compared to the gold, it is much higher. Okay. So this is happening across the time horizons. Whenever there is a slight increase, the gold companies' earnings will increase by a lot higher because it's just a commodity for them, which they are selling basis the market price on demand and supply. So whenever the price is increasing, see their costs remain the same, the profits increase by a huge amount, huge margin, right? So because for the equipment and the personal cost and whatever it is, it would be same. So whenever the price is decreasing, again their personal cost is same, but the price, the amount of profit they will make will be drastically decreasing. That's the reason why whenever the gold is flat for certain amount of time, you will see a big drop, right? So from this point to this point, when the gold was almost in a flat position, the prices have gone down by a huge margin, right? Again, whenever the price is increasing, the gold mining companies will tend to do well. Say, for example, in the last, last 6, 7 months, there has been a huge amount of increase in the gold price, right? So, if you look at it from January to present date, so in the January it was at 206 or something like that. So today it is at 230. That is almost like an 260. So it's an increase of 30%. But in the same time, if somebody has invested in a gold mining company, so from 166 to this is at 238. So almost an increase in 50%. Again, but the falls are also lot more steeper. So this fund is like really very volatile, right? That famous fund manager, which whom I was referring to in one of the interviews was saying, he was saying the same. There is a huge amount of volatility. All I wanted to do is show the data for the same. So let's see from 2012 to today, right? So from 2012 to today, if you look at it, the gold has doubled actually. It gave 100% return in 13 years time, right? The similar duration, the gold mining companies have just stayed wherever they are. It was a negative 4% return. These are both in the dollar terms. Dollar terms, in the 12 years time, it's like 100%. Like somebody invested in January 12, 13 years time, January 2012, they would be having 100% return in 100% return in 12, 13 years time. So S&P 500 and Sensex, both in Sensex or Nifty 500, whatever it is, in the dollar terms have done a lot better than this, right? So, but if you look again at these funds, right? So whenever it is going up, if you let's just look at the, areas whenever the gold price is increasing. So these are increasing with a lag effect, right? So for somebody who may have not participated in this rally, so say for example, even here, right? With the lag effect, these things are increasing and the rally sustains longer when compared to the gold as well, right? From here again, it is flat. So from the time it is flat, this will go down, right? So whenever it is going up, this will start with a lag. Right? That way, again, so when somebody is investing in these mining companies, they should be ready to exit and enter. Right? That's why when you are investing in this product, you have to understand there is a huge amount of volatility and see if it is even suitable to you or not. That's the reason why you have to check with your advisor or a distributor and see if it is suiting your asset allocation and if it is fitting with your goals or not. Ideally speaking, investing has to be done for a very longer durations. But if you are somebody who believes in this, taking these short-term bets with a very small corpus, then probably you can have a look at it, provided you are discussing with your advisor or a distributor, and again, understanding these products in entirety. Because gold is treated as a safe haven, but gold mining companies, again, for any company, you have to understand there is a possibility of them going bust, right? Even though they are just digging the gold, if you look at it in the 2020, there has been a steep drop. That's not the case with the gold, right? So you have to understand all these nuances and then only invest. So this is neither a recommendation to buy nor the sell the asset class in discussion. It is purely for an educational purpose only. Thank you.